return on investment. I thought I'd just put a video out there. Hopefully it'll be quick. Then again, as I start to get into things, I tend to talk way too much. I'm going to have a very informal view of where the markets are at now relative to where I thought we're heading, and where I think that we're going into the future. And so we shall begin super informal, over the shoulder view, if you like, mainly focused on the eToro portfolio, but I'm going to start off with a broad market summary. As you can see here, what I've done is take the last 20 years of the S&P 500 index, and we are currently at around 3674. I have had a short position on since around just over 4,000. I use the SPY, okay, as the ETF that tracks the SPX in 100-point units. Same thing, it's going to mirror the SPX. I took those shorts off at the end of this week at, I think, about a 34% profit. And so I've got a lot of cash there waiting to deploy. So if you're a copy of the eToro portfolio, I will be looking for opportunities to further deploy that cash. I still have a small short position against the NASDAQ. And what are my targets? So I've said for quite some time now, let me get into the 5 years, it'll make it easier. If we go back here, so the end of 2019, okay, so pre-COVID, no one in the Western world was thinking about COVID, and well, maybe not. I certainly wasn't thinking about COVID at December 2019. And if we look at where the Fed's fund rates were at that time and what the market was doing, the market level was at about 3,200, so 3,244 you can see there. It's certainly not out of the realms of possibility that we would come back to that level. And in fact, I'd say that my base case is that we will. And so on the next, if we have a bear market rally, I may re-engage that short position and use the stop losses crashing down even further, which we'll see. I would expect us to at least touch that levels. We may not get down here to March 2020 levels, although it could. The reason I don't think we will do that is because if we put in here in comparison, if we put in the US 10-year yield, bond yields, boom, boom, that'll be in the orange line there. As you can see here, that has gone up. Oh, what's going on here? Get out of that. Stupid thing. That has gone up over 50% from where we were. So we take that off percentage, it's going to be a flat line because it's obviously in single digits versus the index, which tracks into the 3,000. So looking at this bond, if I get rid of that, here we are as far back as the charts will track it. We have the 81 was the peak of interest rates. This is measuring the interest rates on the 10-year, which is a good proxy. It's not quite the Fed funds rate. The Fed funds rate set, and the 10 years a few points above that. But if you can see here, after the inflationary period of the 70s, when the dollar was removed from the true gold standard, okay, or probably more accurate to say, Nixon suspended the convertibility of dollars for gold, essentially had the same effect. We're looking at interest rates around the 15 mark. I'll just move that out of the way there. Listening to a lot of smart macro guys, I tend to agree. The difference to debt to GDP now versus then is obviously night and day. So I believe the debt was around 30-odd%, so 32% of GDP in the United States at that time. If that's not correct, someone please put in the comments, because that's just going off the top of my head. Where we are now with the debt more like 130% of GDP, we can't get to that level without a default, essentially. I mean, unless they'll allow interest rates to rise and then at the same time just go crazy on the money printing and printing off currency units to pay off the debt, which would tank the dollar and not defeat inflation. I mean, they're trapped. They're really in a trap there. They need to allow rates to rise, but at the same time they can't. Where we're at now at a 3.23% on the 10-year, from my understanding, that means that about 20% of the entire tax receipts from the government, so everything that the government collects, is going just to service the interest on the debt. I mean, it really is insane. And so the question we ask ourselves is, At what point are they going to give up? Are they going to stop allowing the interest rates to rise in the US? Now, I don't know where that is, but I know that, well, I don't know. I'm very confident that it will not be 15% for the reasons I just mentioned. And so where is that point? If we look back to 2018, where did we get to? That'll be the key. And if you go back to 2018, at that highest point here, we're at about 3.22. We're getting to that point now. And so the question will be, the market dropped off viciously at that point in December of 2018. I remember it well. And so then we had this famous power pivot. So the Fed then stopped allowing interest rates to rise. They reversed course and the market was happy again, and everything started to rise as you can see here, if you follow the line down, the interest rates dropped. Some interesting points have happened since then. Powell has been renominated and he can't run again. So as far as his career is concerned, this is his last hurrah. He doesn't need to keep the stock market happy in order to keep his job anymore. So it'll be interesting to see how much he bends to political pressure. We're already seeing a lot of pressure in terms of people being unhappy in an inflationary environment. So I don't pretend to know exactly where the 10 year is going to stop, but I doubt we could get to, I really doubt we could get to 8%. I mean, that would be horrendous in terms of the overall economy. US dollar futures, I am looking for one of the dollar indices. This one will be okay. And so if we look at where the dollar is trading, 104, I mentioned this in a previous video, it's super high, okay? It's just super high. Historically, there's only been two more times when the dollar has been this high, and that's been in times of crisis where we have interest rates have to rise to try and stave off inflation. The other thing is that real rates, guys, are still negative. They're still negative. You take we'll use the 10 year, but you can use the Fed funds rate. It doesn't really matter. If you take the 10 year and you minus the CPI is coming in at around 8%. No, I don't expect next year to be exactly the same at 8%. But one thing I am sure of is that it's not going backwards on a nominal basis. So meaning if you were paying $100 for your basket of groceries last year and this year it's $108, it might go to $110. And so the rate of change recorded in the CPI will diminish. But I don't expect it all of a sudden next year you'll be paying $90 for that same basket and same quantity of goods. I do not think that's going to happen. It hasn't happened in a very, 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 very long time. So we need to position ourselves such that our cash is working to provide rates of return higher than at least the CPI. Okay, this is the game that we are all being forced to play, whether we do or do not like it. Okay, so interesting to see where that interest rate will rise, that dollar index will peak also, and then we'll start to have a reversal of course, and it'll be interesting to see where the capital flows. I believe that capitals will flow into things that aren't going to lose money at the same rate of inflation. So what are those sorts of things? Tangible assets and commodities in particular. Oftentimes primary producers use as proxies for commodity producers, for commodities, tangible assets, because they should have a torque to the price, meaning that if the gold price goes up 1%, your gold producer, all things being equal, should also go up 3% to 5%, depending on the amount of leverage that that particular company has to the gold price, of course. Question will be around margins. If we have inflation's eating into the cost of production, we need to be picky about the types of businesses that we own, and those businesses need to have pricing power in terms of their input costs will rise. Can they pass that on to the end consumer? And that is why we've been positioned in sectors with inelastic demand. So regardless of whether there's a recession or not, you still need to have the lights on, you still need to have your electricity. And so energy is where by far and away our biggest weighting in the portfolio. Commodities, you still need to eat, and we still need that prime produce, and a few select businesses that I think will do well over the long term. So let's take a look at where we are in terms of the portfolio. I will get rid of the 10 year and URA is the biggest holding in the portfolio. We're down 18% mark to market, and the portfolio is currently down 17%. Okay, and so let's take a look. URA ETF over here. Okay, over the last 5 years, if we go back, all right, here we are in terms of the uranium bull market. Then we had Fukushima and everything went to hell in a handbasket. And we've had this low, long grinding ever since. Things have changed. Look at the volume. Okay, so look at these bars, green and red bars down the bottom. This is the sign of a market coming back to life. Okay, uranium is certainly one of my highest conviction plays, if not the highest conviction play moving into the future. We need more energy. We need fuel sources that have high energy return on energy investment. I've spoken about this myriad times. Solar and wind are not going to do it. Unfortunately, we do need them, but when you have an energy return on energy investment of, I'll be very generous and say 3 to 5 units for solar, and most of the accounting for that is quite dishonest from what I've seen, versus uranium that is more like 100 units of energy produced for every 1 unit of energy input to harvest that. It's quite clear there's no way we are going to be able to provide for the growing populations in emerging markets, and they're accelerating up their particular S curves in terms of energy usage without harnessing nuclear power. Okay, over the last 20 years, everyone's hated on the fossil fuel industry. The usage of the fossil fuel industry has gone, as a percentage of energy, has decreased by like 2%. Just let that sink in. Okay, we can't, we're not ready to transition cold turkey from one industry to the next. It's not going to happen. So this is a basket of physical uranium, so U3O8, mainly by the Sprott vehicle, but also has some yellowcake. Same idea. It's run by a couple of South African Jewish gentlemen based on the London Exchange. And so it's a funny thing. They have less liquidity, less popularity. They trade at a huge discount to their net asset value. And they store uranium in the same warehouses as Sprott. So it's an interesting play. I own yellowcake and Sprott in my other fund and in my personal accounts. They own producers such as Cameco and Kazatomprom, and they also have a broad exposure to a basket of developers and explorers. The developers are where the most leverage is, in my opinion, because they have found a deposit and they will need an incentive price for uranium of at least, John Borshoff says about $80, $85. So I'm going to go with him. He knows more about it than I do. And so where we are with uranium, I believe it closed. Let's have a look and compare. 308. Okay, take that off percentage. 47. Okay, so it has to nearly double in order to become an incentive price for new production over the next decade. And with Japanese fleet restarting, that's a huge deal. The reason is because they were selling pounds onto the market. So if you have the Japanese fleet restarting again, those pounds that were being added to the market in terms of supply, they're taken off straight away. Not only that, but you have more consumption because you need to be able to feed those reactors. And so it's just going to be very, very interesting to see how quickly that, as a catalyst plus SPUT, so Sprott Physical Uranium Trust, going into the market every day and buying up the physical pounds, really just eats away at the supply. And then the utilities have to come to the fore and sign longer term contracts. We saw Global Atomic and this week, signing long-term contracts. They've hedged their bets out. They sold it, I think it was in the 50s. It might be $58 a pound. I want to say, I'm probably not nailing that. I know it was in the 50s for, I believe, about 40% of their production. So they've got some locked in for long-term contracts at that price that they believe is viable. And they've left all this upside. They've left 60% of their production unhedged. Why would they do that? Because they think the price is going lower? No, because they think the price is going higher and they want to have leverage to that upside. So uranium is something that I'm watching very, very closely. If we go into the lower timeframes and I get the MACD and the RSI. Here we've got a sell signal on the MACD. And so we can get some further weakness for sure. If I put in the moving averages and we really go into it, it's dropped below these averages, okay, which is usually a bearish momentum signal. We will see how we go, but if you look at the RSI, that rate of change of selling pressure, okay, this measures the momentum of selling pressure, is starting to slow. We're starting to bottom out here and get a little bit oversold. I have added more into the fund this week, which has brought it up to being 8.66%. And also because everything else is being sold off, the value of the fund has dropped. The equity value of the fund has dropped. We still have about 70% in cash. And so I expect to add to that up to about 10% of the entire portfolio. That's how high my conviction is when it comes to uranium. And the reason is it's an ETF, so we've got a broad basket of exposure. We have access to the physical commodity, and we don't then have to worry about any one particular company risk. Okay, so if we just bought Kazatomprom, not that you can on eToro, but if we did, then you got to worry about political risk in Kazakhstan, for instance. So very, very bullish on that. I forgot to mention Cape-Shiller ratio. Okay, so I expected the Cape-Shiller ratio to come down to around about 15 to 16 is a reasonable long-term value. So we could see further selling pressure on the S&P for sure. So if we were to get down to another sort of 30, 40, even maybe 50% in a real bear market route, then we would be getting back to decent value. I don't know if we'll get down that far, maybe, but I'll be continuing to scale in as we go, focusing on companies that have high levels of free cash flow, because where we have, if you have your nominal price dropping, but you're receiving cash flow, you're recouping your investment very fast, and everything else on top of that is gravy. That's the way that we've invested. Yeah, we could close that one down. Let's take a look at, well, Royal Mail is just crazy cheap. And I'll take a quick look. Royal Mail. All right. Royal Mail, what are we interested in here? EV to EBIT. So we're paying 6.5 times the projected EBIT next year, which is it's really not unheard of. Price to book, we're paying, at the moment, it's trading for less than the price of the book. What that means, everything the company owns minus everything the company owes is your book value. So if that was $1, you're paying 60 cents for that dollar, all else being equal, and if you believe all the accounting and all the rest of it. Okay, so there's more to life than the book value. I'm not trying to say that it's that easy, but to give you a very quick and dirty overview, that's where we are. So when you open and you see that 6% of your portfolio is down 39%, you've got a decision to make. Are you going to buy? Are you going to sell? And so I've been scaling in. I'm not going to sell something. I'm not going to sell $1 for 60 cents. Sorry. If you're looking for someone to do that, you may be better off following someone else. I'm not going to do it. And the company has a lot of cash on its balance sheet. I'll bring that up here. And so it's annoying when you see that. You're like, well, this is weird. Why is this happening? But it's just the way it is. If we go into the financials, and it does take, so the company has a weird reporting. It finishes here in March. Okay, which is a bit of a strange calendar year. But if we go into the balance sheet, like cash and cash equivalents, you've got, what have we got? 1.137 billion pounds on the balance sheet. What's the market, what's the market cap? Yeah, so they've got about a third of their, more than a third of their market cap in cash. I mean, that's crazy. So for every dollar you're paying for this particular business, you're getting roughly 33 cents back in pure cash on the bank account. So if we allow for the debt, if we go 3605 divided by 1137, I believe, close enough. So you're paying the enterprise value is 3 times the cash on the bank account. Crazy valuation. If we look at the free cash flow, 15%, that's not bad. And you get an 8% dividend yield while you're waiting for the market to realize that. You look out into the future, you're looking at street targets 4.83. That's come down a bit. My target is more like £6 to £7 on this particular business. It's not going to be a tech stock in terms of its growth in top line revenue, but it'll be able to plug away. The reason the market doesn't like this is because it believes it's going to have shrinking margins. It's offset that by buying back 10% in dividends and in buybacks over the last year. So I think it's a boring business that's going to continue to be necessary into the future. And what can I say? I look at the book value at £5.35 and it's trading at £2.72. I mean, you're paying roughly half the book value. It's logical to buy these things and hold. Whether the market then gives you a further discount and sells it off after you bought it, well, so be it. That's why we try and scale in. You don't always nail it, but over the long term, is this something that is, am I really paying too much for this business? Do I want to own this business? The answer is yes, I want to own the business, and no, I don't think I'm paying too much. Paying half the book value is not particularly expensive in my opinion. Next up, XOP is a oil and gas explorer ETF, so you get broad exposure. There are a few in this particular index that are available on eToro, and so they would be Range Resources and Ovintiv, and some of these. I spread the risk out a little bit more because these are explorers like Matador, Viper, and these types of guys. Some of those you can't buy individually on eToro, and so I chose to look at the upside into the future for energy. We're going to need more exploration, particularly in oil and gas, whether the greenies like it or whether they don't. And these are the companies that are going to benefit from that. The world is literally relying on these companies to save the world. Everyone hates them. And the irony of it is we are relying on them, and particularly people in poorer countries, emerging markets, are relying on these guys to have people leave them alone and get out there and produce more energy. It's really as simple as that. If I take a look here, and what we will do is compare it to oil futures. Come on, guys. Crude futures from the NYMEX. Beautiful. And let's take a look. So if we zoom all the way out to give us a big picture look at XOP. So this is the performance of this particular ETF. So we'll get rid of the oil price for a moment. Here you can see holding well above trend line, well above all the moving averages. We've got a buy signal on the MACD. We've got a little bit oversold, and so we've had a drop back recently, which is where you've seen this particular pattern drop down. And the previous high on the shale boom in 2014, just nudging 300. Okay, so here we are. So 298, 299, call it, we'll round it up, was the previous high. I think that we will smash through that on this particular cycle. That was the shale revolution. If you read Goering and Rosenzweig's research, they believe that basically because oil prices went so silly and these guys loaded up on bank debt to finance more production. That was how they were operating back then. Complete contrast to today. The shale guys are basically high graded. So they took the oil that was easiest to get. All of that has already been drilled now. It's not there. So if you had an incentive price of oil at, call it X dollars, well, that was to get the easy stuff. And so moving forwards, you've got this lack of supply, and it's harder to get that supply. And you've had cost inflation. All the things I've been banging on about for 2 years now is not on the channel, but at least for 2 years. Then it just stands to reason that oil prices are going to be higher than they were at the previous peak. And these guys are going to need that in order to have that incentive to get back to production. When that happens, I mean, these guys are printing cash as it is now. When we get oil to, $185 a barrel WTI or crude, these guys are easily going to surpass where they were last time, where oil was at, I believe 140 was where it topped out. Okay, so here the oil futures tracking underneath. As you can see, they will obviously have a very close correlation in their relationship. And gas prices, looking at coming into a gas crisis in the later half of this year, might get a little bit of sell-off over the summer in the US, but you've got, on a Henry Hub equivalent, you've got Asia and Europe paying roughly $30 MMBTU, and then you've got the US is paying somewhere around 7 and 8. It's been hovering over the last week or so. And so many people, myself included, believe that that will start to converge, which for the gas explorers and producers is just going to be another thing pressuring them upwards. GoPro is a great business that people don't, as far as I can tell, don't seem to understand. I mean, GoPro is not just a hardware business anymore. They have their software subscription, and that's going to increase their margins moving into the future. So we're paying 5 times next year's EBIT because they've had an earnings revision. Okay, and it's annoying. We're paying 1 and a bit times the book. Nothing crazy there. In terms of stock repurchasing, they're buying back more of their stock, as you can see in the green line here. And EV to EBITDA in the next 12 months, under 5. So again, do I want to own the business? Yes, I want to own the business. At this price, yes. Isn't it an expensive business? No, it's not an expensive business at all, as far as I can tell. GoPro, well, I expect their margins to improve. People are worried that they are going to sell less cameras coming into a recession. They probably will, but they will also have the continuing subscription revenue from their users. So they've converted themselves from a hardware business into more of a software subscription business. And moving forwards, I think that the camera itself will be unimportant for GoPro. It'll be a loss leader. They'll sell it at cost value, and they'll make their money on the back end with continuing and sticky subscription revenue. Okay, that's what I think GoPro will do. Here we've got some earnings estimates. Let's see if I can get that from 21 is probably a better idea. Moving ahead at 8%, I think that's understated. I'm waiting for the company to come up with a half year review. Free cash flow here, declining by 40%. Big call. I guess we'll see. And again, that's why I'll be keeping an eye out for the reports every quarter. I think that where your margin of safety you gain for GoPro is in the expansion of their margins and their cash. So their cash is building up. Cash in short term 538, call it 539 rounded. And it's basically half the market cap. Okay, the EV is less than the market cap, meaning they got more cash, more outstanding assets and liabilities. So let's use the enterprise value. So 788 divided by 539, I believe it was 1.6 times. 1.6 times. You're paying $1.46 for every dollar in the bank account expected by the end of the year. Okay, you're paying half the market cap in cash. What can the company do? If the stock is still depressed, they'll buy back the stock, which is set a floor under the stock price, or they'll dish it out straight as a dividend. Okay, I don't want to see them engaging in more R&D, so trying drones and stuff that they've done in the future. If that's what they're going to do with the cash, then that would be an issue, because I don't want them burning it. I want them to give it back to me, either buy back the stock or give me a dividend. Don't stuff around, basically. Micron is one of the most important conductor manufacturers in the world. Okay, semiconductors are one, if not one of the most important industries, up there with energy. And so here we are, Micron still above its 200-day moving average. Okay, so we've got a bit of technical noise, I would say there. Same in the 5 years. And if we dish in, yes, over the year, it has dropped down quite significantly with a lot of selling pressure. We're hitting down here on the oversold on the old RSI, which means we could see a little bounce. I would be keen to add more to my position in Micron, maybe building it up to around 5%. If you listen to Manish Pabrai talk about Micron is essentially the gatekeeper for the semiconductor industry. They don't have major exposure to Taiwan either, which is extremely important. And you're essentially clipping the ticket with Micron. So you get a cut of all the flow through revenue when it comes to the semiconductor industry, which is why he's attracted to it. And it's why I'm also attracted to it. I think that that is a good thing. Okay, let's take a look. Micron, EV to EBIT, next 12 months. You're paying less than 4 times the EBIT for one of the world's largest semiconductor manufacturers. Unless you believe that semiconductors are going out of fashion, which I don't. I think that obviously it's a good buy if you're someone that's my way inclined. Not advice, just my opinion again, as always, guys. Price to book 1.3. These companies traditionally trade around 2 to 3 times the book value. Very expensive to set up a semiconductor foundry. Intel are doing it over in the US. I did own Intel. I sold it at a small loss because I think there are better opportunities out there. Currently, the market is punishing people investing in CapEx for the future. And I think Intel is an interesting story, but there's a lot more that can go wrong in the future, where I can buy Micron, for example, at less than 4 times the EBIT for next 12 months and at 1.3 times the book. Or I can invest in uranium or something that is more attractive to me right now. So I made that decision. I took the medicine and sold out. Free cash flow to enterprise value. I mean, you're getting an 8.3% on the entire company, which includes all the debt on its balance sheet. So not too shabby. You'll keep a flash with inflation. A lot higher than a bond. Yes, there's a bit more risk, but I think that over the long term, they'll be able to deploy their capital very well. Glencore, we know Glencore. Petrobras sold off 16%. I want to build it up even more. I want it all. I want it all. There's more risk involved in Petrobras than some of the others, but I'll finish with Petrobras because I've got to get on a call in a second. EV to free cash flow to EBIT, EV yield, sorry, 31%. I mean, it's just crazy. If you're a cash flow investor like myself, and you're paying less than the book value. So if you're worried about the balance sheet, you're paying less than the book value. Pretty simple, nothing too much to report there. All right, guys, I'll leave it there for now. If anyone's interested in other positions that I've taken, then by all means, put it in the comments section. Otherwise, I'm going to keep my 17% cash, keep my short on the NASDAQ, you can see here. And then when it comes time, I'll start to pull the trigger and going long. If we get a bear market rally over the next month or so, I may then put another short on the SPX. I'll wait and see. We'll have to see what happens in terms of the momentum. Thank you for watching. If you haven't already liked and subscribed, I appreciate you doing so. Otherwise, I wish you all the best. Disclaimer, none of this is advice, guys.